Welcome to Drill Down Earnings. We have quarterly results out from Hewlett Packard Enterprises. This is the business story behind one stock on the move. I'm Cory Johnson, Chief Market Strategist for Epistrophy Capital Research. We look at the 50 most interesting companies in technology. HPE, way up there. Such an important company. The market hates these results. Let's look at them and figure out what we got. So Wall Street likes a beat or a miss. This is Q4 earnings for this company, the quarter ending in January. This was better than the estimates, better than my estimates, better than Wall Street estimates. $7.9 billion in revenue, 49 cents in earnings per share, and yet, although they beat, the guidance for next quarter was disappointing, as were the margins in their most important product category, servers. So let's dig into it here. So this company, split off on its own 10 years ago and has been a really great success in the last 3 or 4, or maybe 5 years under Antonio Neri, the CEO. Hewlett Packard anything, let alone Hewlett Packard Enterprise, is a great success. It's something, words I would never thought would have come out of my mouth. But this company is doing really well. But this quarter is a little bit disappointing. And indeed, in the quarter, Antonio Neri said great things about the exciting innovation that they had in the quarter, the customer enthusiasm, the track record of consistent and disciplined execution. But we could have executed better, he said. If you look at the top line numbers, you can see the double-digit, 16% year-over-year revenue growth, really good, but kind of leveling out from last quarter. And when you look a little bit deeper, and we can go beyond those headline numbers, you start to see what's going on. So servers have become a huge part of this business, 54% of revenues, and that's all about AI. And when the server business didn't do great, did good, not great, that kind of dragged down all of the Q1 results. The other business units kind of did okay, but that giant server business, 54% of revenues, tailing off a little bit and dragging down results. On a year-over-year basis, well, on a sequential basis, we saw a decline in the server business for the first time since early 2023. So that was really disappointing. Margins held in okay, EBITDA margins, operating margins, if you will, at 7%. That's kind of where they've been for a while. You might have hoped that would get better with the great business that they've got there. And I think the result of the guidance that they saw, the lack of fantastic profitability in their server business, caused the stock to fall. Stock was down 20% in after-hours trading after declining 4% for the year going into this. So really big decline for HPE. Now, there were a couple things to talk about. One important thing I want to mention here. So the acquisition of Juniper, they are going to go to trial for this. In the end of January, they got kind of a surprise Department of Justice complaint about this merger. And they filed answers to that in February 10. They say they're going to trial in July 9. And they think they're going to win. Obviously, they think that they've got a case for this big acquisition. I think the acquisition is probably more about AI, less about wireless networks, which is, I think, the way Juniper is being seen in the marketplace. I want to talk about backlog briefly. $3.1 billion backlog bounced back. There was this mysterious customer last quarter that went away at the end of the quarter. They wouldn't say who it was. They just thought there was a risk. So they de-risked that backlog. They de-backlogged it, if you will. They added new numbers to it at the end of the quarter. They didn't tell us what it was, but now we see at the end of this quarter, we're right back to $3.1 billion. But it's kind of interesting here, you see these margins dipping and you see this bumpy backlog. You wonder what is the state of selling servers. In particular, HPE is not selling to Amazon, to Meta, to Google. They're selling to kind of sovereigns, and they're selling governments. They're selling to big businesses that aren't the hyperscalers. So there might be more margin there, at least you think there would be more margin there, but also not as much cutting edge product. The result is the margins in servers this quarter, they said they screwed up. They said they were down to 8% in operating margins, maybe not what you'd hope for at this point in time for HPE here. Here's what Antonio Neri had to say about those margins and about the shift from the Grace Hopper, the older school NVIDIA chips, to the cutting edge Blackwell. Here's what he had to say.
In Q1, we saw a quite significant amount of orders on Blackwell. In fact, I think I said 70% of the mix of the 1.6 billion was Blackwell. When you go to the other two segments, the sovereign and the enterprise AI, that's not the case. They go with a combination of prior technologies and maybe new technologies in the sovereign. And an enterprise market definitely is N-1 or even -2 for that matter. And so that's why that inventory in the AI that was higher than normal is because now will take a little bit longer for us to basically transition that inventory as we go through the other two segment consumption, while the service providers and the model builders will shift much more quickly into the latest technologies. And that working capital, because in the end, it's all working capital. Pressure is not so much the margin pressure of what you sold when, is what compounded the issue in our Q1. And it will take, like we said, 1 or 2 quarters to convert that backlog, the $3.1 billion, into revenue, plus new orders are coming in, and then return the traditional server business to the what I would call more normal operating margins, because that was mostly impacted by the what I call the higher discounting, and that one-time thing, we would call it the value of our inventory itself.
So there you have it from Antonio Neri telling us that backlog is going to start to materialize with some better margins, but maybe not just quite yet. And I think that given his comments last quarter about some backlog disappearing and saying, don't worry, it's going to come back, and it did, I think we can trust the guy. All right, what's it all mean? What's your drill down takeaway? You're the one number that tells us a whole lot, the drill down earnings bite. I have that too. So Q4 earnings from the Hewlett Packard Enterprise, a really important company in the world of selling servers and AI machines loaded with NVIDIA chips. That was a really strong quarter for this company. Growth has rebounded here, 16% year-over-year growth in revenues, but that was kind of flat with last quarter, a little bit disappointing. I think the biggest concern was that server growth has kind of stalled out, but hey, server growth is up year-over-year at 29%. We only have a 2 years worth of numbers there when they broke out this unit separately, but 29% year-over-year growth in a fantastic year, biggest business at HPE. Wall Street doesn't like it. I do. All right, thanks for checking out Drill Down Earnings. I'm Cory Johnson.